Hello and welcome to What's in It for Africa, the Inside the Issue show with me, Uzo Madu. On the show this month, we're going to be exploring the EU's anti-tax avoidance package, which was released at the start of 2016. And to help us with the African perspective, we're going to be speaking to tax campaigners from Uganda, Malawi, Nigeria and Kenya. The EU sets out new rules on tax avoidance, but what is it? Well, it's the legal practice of minimising a tax bill, either by taking advantage of loopholes or exceptions in the law, or interpreting the tax rules in order to lower your tax bill, even though it was not the purpose of the rules put in place. So common forms of tax avoidance include shell corporations, tax havens like those in Luxembourg and the Seychelles, and complicated tax schemes. Tax avoidance can be distinguished from tax evasion, which is illegal and covers actions taken to avoid liability, including concealing taxable income from revenue services. So, if tax avoidance is not per se illegal, then what really is the problem? We speak to Henry Ushie from Oxfam, Nigeria.
It's a very serious issue because most entrepreneurs feel they have the right to put their money where they want to put it, and then they feel, because of the open border system, the global system, where borders are open and then financial systems, can be transferred anywhere without any restrictions and all that. That's the big problem we have, because with these people, or these so-called elites who have held sway for over a long time, feel that maintain the status quo, it's a do or die affair. So what they try to do is to keep on strengthening the system with every possible legal framework they have to ensure that this thing continues, so that their banks, wherever jurisdiction it is, keep receiving these monies, and then their companies abroad keep pushing these monies from wherever they are, to this bank. So there's a connection between the banks themselves, the companies, and then the government of those jurisdictions. So it's a tripartite thing where these bigger stakeholders, the bank, the companies, and the governments, should come together to ensure that this thing, is curtailed. But the thing is, the reason why this thing holds sway, basically, like I said earlier, is because they want to maintain the status quo. We all have a common enemy, and they are the people I've mentioned, the three stakeholder group I've mentioned, the banks, the companies, and this government, particularly the government of the 20, because the G20, they are the ones who have these big companies abroad. They are the ones who, this bank are in their jurisdiction, and they don't call the banks to order. They don't call their companies to order. So it's a very serious thing around the world. And, I think national government should begin to be more responsible, by strengthening their legal framework, closing the loopholes, and ensure that these companies begin to do the right thing, begin to pay their taxes where they make their profits.
Tax avoidance and evasion cost the African continent somewhere between 30 and 60 billion US dollars every year, with 65% of this total coming from legal activity. And to put these figures into context, 20 billion per year in extra income is needed for the African continent to catch up to the development status of industrialized countries. Also, considering 30 to 60 billion US dollars per year is leaving the continent due to these practices, it is interesting to note that in 2014, a sum of 30 billion US dollars in global aid was given to sub-Saharan Africa. So considering these aid figures, we asked, does Africa need aid?
I'm going to tell you truly that Africa does not need aid. I'm saying this because what we get to lose through this illicit financial flow is enough to fund what Africans need. Given that we have so many natural resources, not just in Nigeria, where I'm from, but basically almost all the African countries should have one thing or the other that they have as a natural resources. I happened to see a report done by AU. I don't know if you heard it when they said it there, chaired by Thabo Mbeki, that for every $3 that African loses, for every $1 that we get as aid from European countries or from foreign countries, we get to lose 3 through illicit financial flow. So if we get everything that we desire, that we deserve, if there's a fair share, if the multinationals get to pay a fair share of their tax, Africa does not need any aid from them. In fact, we should be the donors. We should be giving them aid if we mine all the resources we get, or if those multinational companies that we welcome into our country get to pay their fair share of taxes. Africans should be the donor, not the other way around.
And the main culprits of tax avoidance are multinational corporations, because these corporations are able to engage in complicated avoidance schemes across a number of international tax jurisdictions. The top 20 European multinational companies have a combined market value of around 2.2 trillion US dollars. Also, flows of investment to developing countries via low tax havens have doubled in the past decade, with the bulk of these flows accounted for by the Netherlands and Luxembourg. So what is the EU doing about it? Well, it proposed at the start of the year an anti-tax avoidance package, which includes an anti-tax avoidance directive, also measures on country-by-country reporting, and an external strategy on fair taxation. In the Anti-Tax Avoidance Directive, there are a number of measures with a particularly strong external and therefore African component. These measures include a switch over rules which allow EU countries the ability to tax dividends coming into the EU if they are not taxed properly. Also, rules on anti-abuse, which essentially allow EU countries the power to tackle artificial tax arrangements, and rules that allow the EU to tax profits from companies that shift them to low tax countries. Another solution proposed by the EU is country-by-country reporting, essentially multinational corporations operating in the EU with global revenues above 750 million euros a year would need to publish key information not only on where they make their profits, but also where they pay their taxes. And the EU external strategy on fair taxation includes a naming and shaming list of third countries that are not respecting good tax governance standards. And attached to this list are a set of clear conditions for them to improve their governance standards and therefore be taken off the list. And the EU external strategy also sets out core elements for good tax governance clauses, which will be included in all EU proposals for trade agreements with third countries. And finally, the EU proposes to support developing countries in building up their tax capabilities in terms of policy and administration. So, with such a wealth of measures proposed by the EU, we asked our tax activists, is this enough?
One thing that they've mentioned is that they want to support developing countries' capacity to mobilize tax revenues and also curb tax dodging, which is very good. I think there are a number of developing countries that are struggling, to cope up with the tactics that multinational companies are using to dodge, taxes. But I think, good as that may be, I think we need more than just capacity. Civil society organizations have, for example, requested that, the EU or the EU supports public country-by-country reporting. But I think our demand is that, this public country-by-country reporting should be global. It should not just be at EU level. It should be global. It should cover every country. They are saying they've put a threshold of companies that are earning a minimum of 750 million euros to be obligated to disclose information. But we are saying that will leave out a lot of multinational companies. Okay? The figure that we have proposed is a turnover of 40 million per annum. So again, there we have a problem. So in a nutshell, I would say the response is not adequate. The response of the EU is not adequate to address the problem of tax dodging and tax avoidance and tax evasion?
First, it's good they have policies addressing tax evasion and tax dodging. It's very, very impressive, and it's good to know that those policies are not just for European unions, happening within Europe alone, but that it has the interest of developing countries. But one major thing that I feel they should still try to see how they bring that in is to see how like the BEPS projects, how developing countries can really be on this table. Like they should not just have that purpose of having to bring suggestions, and if you like, they take to it. If they don't like, they don't take to it. So it's not enough for somebody to speak on your behalf. It's okay for you to be there to say what you're really going through, what you are experiencing. And I think the best story comes from the real person in the situation. And when you have to say it for somebody, it's already turning hearsay, and there might be some reduction. It may not be up to what it is, but if these developing countries are included in these policy decisions and all that, and they are able to express and say where all these things, how deep this thing has eaten into their economy, how tax dodging has eaten really into their economy, it will be more better. Make sure we know who are the real beneficiary. It's very, very important, because it's another way of trying to know who runs this company, who is benefiting, and who owns the company, instead of trying to, divide the companies in several segments, and before you know it, they just use that avenue to just keep dodging payment of tax. So I'm happy about the policies, but I feel the little they need to still add in is to see how developing countries can be well represented by their own members when decisions are taken.
And despite the wealth of EU rules around tax avoidance, it's still extremely difficult to recover these funds back to their rightful owners. And at the EU level, this is explicitly not being dealt with. So we decided to talk to our tax activists to find out how we can close this gap in enforcement.
It's a very fair proposal that monies that have been stolen from developing countries must be, or even developed countries must be repatriated from, back to the places where the monies were stolen. It's a justified demand. That money, the money stolen, could have addressed a lot of social problems, a lot of developmental challenges, and so the measures that the EU and the global community should put in place should be punitive enough. If they find the multinational companies that has siphoned money out of a country, there must be a system to take that money back to where it was stolen. And this is why we are calling for a global tax body. That would be the only ideal, institution to handle such claims. Otherwise, if you do it at regional level or at country level, it's almost impossible. It's almost impossible to collect that money. So I think from my perspective, a global tax body would be, I think, an ideal institution to handle the issue of repatriation of stolen monies.
Another crucial consideration for tackling tax avoidance on the African continent is the sheer lack of tax governance. Although improving, 5 of the largest tax collectors on the continent account for a whopping 68% of the total continent's tax revenue. Also, there are only 3 African countries with units able to deal with the most common forms of tax avoidance. So we spoke to tax activists from Kenya working in Malawi to discover a bit more about how tax avoidance can be tackled considering the weak institutions.
I'm one person who believes that Africa has got a lot of capacity, we just don't use it. We have got very many people who are educated, we have got very many tax experts in our countries. We are not taking advantage of those people to set up the systems. I think it has been very expedient for certain economies not to have those systems, so that they can be able to take advantage of the opportunities that come with multinational corporations that want to bribe them to be able to get access to the economies. So the first thing that African economies need to do is to, one, set up those systems in the first place, seek capacity elsewhere if they truly lack it in the country, which I doubt. And then apart from that, they should also now begin curbing some of the opportunities available for people to take advantage of the economy. There are individuals who negotiate on behalf of our continent every time we have to get into a partnership with a multinational corporation. Those individuals need to be put in check. And I think the best way to do this is for governments in Africa to ensure that there's parliamentary oversight over these negotiations. I know an example of Malawi where a lot of the contracts for the extractive industry are done without any consultation with Parliament. I know in Zambia it was a similar situation. Nobody was declaring how much money was coming out of the sugar plant until Zambia had lost too much money. There is mining of a lot of resources in Uganda and Kenya, especially oil, because oil was recently found. Nobody's talking about the amount of deposits we found. In Kenya, there have been analysis being done for too many years. When are we going to know how much oil we have, how much it is worth? You know, this kind of thing. So a certain level of transparency also needs to be applied in Africa, number one. But they need to also have the goodwill to set up those systems. Because if the competency exists, then they should be able to use it. That is the first thing. The other thing is to ensure that they limit opportunities for people to take advantage of the system by ensuring that they review legislation. I know there are many companies that have gotten away with capital gains tax because nobody in the country bothers to follow up, and there are no laws compelling them to actually pay those taxes. So if they can begin reviewing their policies to ensure that some of these loopholes are covered, it will really help the continent in terms of ensuring that we deal with the tax injustice problem. And it will also provide a good platform when eventually we start collecting the proper tax that we should be collecting.
And linked to the lack of tax governance on the continent, there is still much work to be done. For example, around taxing the informal economy, which accounts for around 55% of the GDP on the African continent. But also the imbalance of the tax mix, which means that the continent tends to largely rely on a very narrow set of taxes in order to generate revenue. So, in conclusion, there is much more to be done in excess of the EU's anti-tax avoidance package. Thank you for watching the Inside the Issue show this month, and remember to subscribe to our mailing list for plenty more news and analysis on EU-Africa current affairs. See the video description box on YouTube or visit our website for more. And remember, only 2 more weeks until your next dose of EU-Africa current affairs with the EU-Africa Update Show. Remember, until then, subscribe to our YouTube channel, follow us on Twitter and like our Facebook page, and you can also see us on Afroland TV and Quick TV Africa. My name is Uzo Madu for What's in It for Africa.